Welcome back to Module 12, Deferred Taxes. The last thing we were talking about was balance sheet classifications. And by the way, they do ask questions on that. All right, now, let me show you a multiple choice on that. It's 35. Now, it says, Thorne applies Statement of Financial Accounting Standards 109, Accounting for Income Taxes, at the end of 2008. The tax effects of temporary difference were as follows. Now, there is an accelerated tax depreciation timing difference, and it's related to a non-current asset, and because it's related to a non-current asset, then the deferred tax liability, which it is $75,000, all right, will be shown on the balance sheet as a non-current liability, all right? So make that $75,000 non-current. All right, now, we have additional cost in inventory for tax purposes. All right, now, that causes a deferred tax asset. See that? $25,000. Now, what's the related asset classification? That is current. So that deferred tax asset of $25,000 will always remain current. All right? Now, we have definite classifications here. Right? The $75,000 is a deferred tax liability, all right, which is non-current, and we have a $25,000 deferred tax asset, which is definitely current. So therefore, all right, we don't care how much will reverse itself during the next 12 months because it will retain this current and non-current status. All right, we only worry how much will reverse itself during the next 12 months. All right, and that's the current portion when you can't relate it to any specific asset, in this case, or liability. Now, let's see what it says here. A valuation allowance account was not considered necessary. All right, don't worry about it at this point. Now, Thorne anticipates that $10,000 of the deferred tax liability will reverse itself in 2009. Now, the deferred tax liability is $75,000, even though $10,000 will reverse itself during the next 12 months following the entry. We have determined that the asset classification it's related to is non-current. So we don't care how much reverses itself during the next 12 months. So therefore, all of that $75,000 will remain as a deferred tax liability. Now, if we could not relate it, then $10,000 of the $75,000 would be a deferred tax liability, right, in 2008 balance sheet, and then the other $65,000 would be non-current. But once again, if you can relate it, we don't care how much reverses itself during the next 12 months. All right, in Thorne's December 31st, 2008 balance sheet, what amount should Thorne report as a non-current deferred tax liability? Now, we only net non-current against non-current. All right, now, let's see what we have here. We have a non-current deferred tax liability of $75,000, but we don't have any non-current deferred tax assets. So therefore, what do we have here? We will show on the balance sheet a non-current deferred tax liability of $75,000. Notice, I didn't use the $25,000 deferred tax asset current because you can't net non-current against current and vice versa. All right, so my answer there is $75,000. All right, and that is answer D as in dog. All right, now let's go back to handout 37. Letter C, a valuation allowance account. Now, valuation allowance accounts only apply to deferred tax assets because deferred tax assets are like receivables to you, the company. Now, it says this: if it is more likely than not, greater than 50%, that the deferred tax asset will not reverse itself in the future. If you have set up a deferred tax asset in the current year, that means that in the future, you're going to collect that amount from the government. Now, once again, all right, if it is likely that more than 50%, all right, will not reverse itself, which means you will not collect that deferred tax asset in the future, then you have to set up an allowance account, just like we set up allowance accounts for accounts receivable. All right. Now, right? Notice my entry here, debit income tax expense 400, credit valuation allowance account 400, all right? Now, let me tell you this. Let's assume that $400 of the deferred tax asset, all right, is not going to reverse itself in the future. Let's assume 400 is not going to reverse itself in the future. What entry will you make at the end of the current year to show that? All right? Well, this is what you do. At the end of 08, please put this down. You will debit income, tax, expense. All right? I don't have this in the notes. Write it down now. Deferred. All right? And I told you that was for $400. And then you're going to credit a, all right, valuation allowance account for $400. All right? Now, why do we have a debit to income tax expense deferred? Well, if we're not going to collect the deferred tax asset in the future, which would reduce income tax expense deferred in the future, now our income tax expense in the future, all right, is going to go up. All right? That's why we debit income tax expense deferred 400. Now, this valuation allowance account is a contra account to deferred tax asset. All right? Now, let's assume the deferred tax asset is $10,000 in my example here. All right? In the balance sheet, you will show deferred tax asset $10,000, all right, less the allowance of $400, all right, for a net of $9,600. Now, please note, you have to do the allowance calculation, all right, if it is likely that more than 50% of the deferred tax asset will not reverse itself, all right, for both current deferred tax assets and for both non-current deferred tax assets. Okay? All right, now, letter D is net operating loss carrybacks and carry forwards. All right, now, all right, don't look at my handout because after I created the handout, I figured out an easier way to do the questions dealing with net operating loss carrybacks and carry forwards. Now, you know that for tax purposes, if you have a net operating loss carry back, you carry it back 2 years to the oldest of the 2 years. And then, if you can't carry it back, you can carry it forward for 20 years. Now, let's look at multiple choice number 30, all right, and then we'll look at 32 and 33. All right, now, number 30. Dix is a calendar year corporation and report the following operating income loss before income tax for its first 3 years of operations. In 2006, they had $100,000 operating income. In 2007, they had $200,000 operating loss, and 2008, $400,000 operating income. Now they say there are no permanent and temporary differences between operating income loss for financial and income tax reporting purposes. So, if these are operating income and losses, and there is no temporary or permanent differences, then these amounts are also the taxable amounts. All right? Now, let's see what it says here. When filing its 2007 return, Dix did not elect to forego the carryback of its loss for 07. So notice in 07, they have a loss of $200,000. They did not elect to forego the carryback. So what they're going to do is they're going to carry it back first, and then if there's anything left, they'll carry it forward. All right? Now, assume a 40% tax rate for all years. What amount should Dix report as income tax liability at December 31st, 08? All right? Now, if there is no permanent or temporary differences between operating income for financial and income tax reporting, all right, then the only type of income tax expense you can have is income tax expense current. All right? You can only have deferred if there's a timing difference. So if there's no temporary differences, all right, or permanent differences, then the income tax expense you will come up with will be income tax expense current. All right, now, let's see what we do here. They want to know, how much should Dix report as income tax liability at December 31st, 08? Now, we go to the 07. there's $200,000 of taxable loss. That is a net operating loss. Now, what are we going to do with that $200,000? We're going to carry it back to the prior year, 2006, which will give us a taxable income for 2006 now of 0, and we will get a refund from the government of the taxes we paid on that $100,000 taxable income. Now, what does that give us for 07 to carry forward to 08? All right, we still have a $100,000 net operating loss from 07 that we will carry forward and reduce the 08 taxable income. Now, the taxable income was $400,000 for 2008. We carried forward an NOL loss of $100,000. So our new taxable income is what? $300,000. Now, we're going to take our taxable income of $300,000, all right, and we're going to multiply it by the current tax rate. The current tax rate is 40%. 40% of $300,000 is $120,000. Now, what is this $120,000? All right, this is your income tax expense current, and the credit is to income taxes payable for $120,000. Now, what's the question asking? What is the income tax liability at December 31st, 08? And the answer is it's $120,000. Now, let's look at question number 32. All right, Bishop began operations in 06 and has an operating loss of $200,000 in 06. Operating loss means a loss on the books. All right, and they also have an operating loss of $150,000 in 07. For the year ended December 31st, 08, Bishop had pre-tax book income of $300,000. For the year period 2006 to 2008, assume a tax rate of 40%, and there's no permanent or temporary differences between book and taxable income. Now, it says here, all right, because Bishop began operations in 06, the entire amount of deferred tax assets recognized in 06 and 07 were offset with amounts added to the allowance account. Now, I'm going to tell you this, all right? There were no permanent and temporary differences, all right, for the years 2006 through 2008, all right? And they began operations in 2006, all right? So therefore, they don't have any deferred tax assets or deferred tax liabilities, all right? And also, their operating losses, all right, are also their taxable losses on their tax return. Now, it says here, in Bishop's 2008 income statement, how much should it report as current income tax expense? All right, now, let's go to the years. First of all, they began in 2006, so they have a net operating loss of $200,000. A net operating loss in 2006, and that amount is $200,000. All right, now, they also have a net operating loss in 2007 of $150,000. And remember, the first year of operations is 06. So the net operating loss will not be carried back. It will only be carried forward because the first year they had a loss was the first year they began operations. All right. Now, what does it say here? They did have taxable income, all right, at December 31st of 08, and that taxable income is $300,000 because book and taxable income are the same because they have no permanent or temporary differences. All right. Now, what are we going to do here? All right, we're going to take our net operating losses and carry them forward against our taxable income for 08. All right, now our taxable income is $300,000. Our net operating losses are $200,000 and $150,000. So our net operating losses are $350,000. So notice our taxable income at the end of 08 becomes 0. If our taxable income is 0, and by the way, still notice, we have a $50,000 net operating loss carry forward, all right, to carry forward to future years. But our taxable income in 08 is 0. So what is our income tax expense? Letter A, it is 0. 0. Okay? All right, now let's go to 33. 33 is just like number 30. Moab reported the following operating income loss for the first 3 years of operations. 06 has a positive $300,000. 07, $700,000 loss. 2008, $1,002,000 income. For the year, for each year, there were no deferred income taxes, and Moab's effective tax rate was 30%. In his 2007 income tax return, Moab elected to carry back the maximum amount of loss possible. Additionally, there was more negative evidence than positive evidence concerning profitability for Moab in 08. In his 2008 income statement, what amount should Moab report as total income tax expense? Now notice, it says, for each year, there were no deferred income taxes. So that means that there were no timing differences. If there's no timing differences, the only income tax expense they can have is income tax expense current. And also, if there are no deferred taxes and there's no timing differences or permanent differences, then the income from operations and the loss from operations are also their taxable income and taxable loss. For example, in 06, we have taxable income of $300,000. All right, 07, we have a taxable loss of $700,000. And in 08, we have taxable income of $1,002,000. All right, now, what do we do to come up with our total income tax expense, which is only income tax expense current, because there are no deferred taxes, no permanent or temporary differences. All right, now, I go to 07, $700,000 loss, and I carried back $300,000. All right, so I'm going to get a refund from my 2006 taxes on my taxable income of $300,000. All right, now, what do I have left to carry forward from my 2007 taxable loss or net operating loss? I have $400,000 to carry forward. All right, so I take the $400,000 and reduce the $1,002,000 by the net operating loss carry forward of $400,000. So therefore, what is my taxable income for 12/31/08? All right, I took $1,002,000 minus the net operating loss of $400,000. My taxable income after NOL is $800,000. All right, so therefore, at 12/31 of 08, my taxable income after my net operating loss carry forward is, what did I say, $800,000. Now, what's the current tax rate in 08? All right, it is 30%. So I multiply this by 30%, and that is $240,000. The $240,000 is my income tax expense. Actually, income tax expense current. Now, why don't they say, all right, why don't they just say, what is my total income tax expense current? Because, all right, the only income tax expense you have is income tax expense current. So therefore, on the income statement, it'll show total income tax expense, all right, and right before that, you will show it's due to a current income tax expense of $240, all right? So you'll have current income tax expense of $240, underscore total income tax expense $240, letter C. All right, now, one more thing, all right, on page 37 of the handout, all right, it's an excellent statement I made here, all right. It says here that, let me get this down here, all right. It says here, the equity method is also a timing difference. Excellent, all right. Any questions on that? No. All right, now, what is the equity method? If you have an investment of which you own 20% to 50%, there is a presumption that you can exercise significant influence. And if you can exercise significant influence, you have an investor-investee relationship. Now, at the end of the year, all right, as an investor, you have to pick up your share of the investee's net income, and that will do two things. It'll increase your investment account, and you will credit an account called equity and earnings, all right, which is a book income statement account. All right, it's an income account. Now, let's look at letter number 28. All right, Bart, a newly organized corporation, uses the equity method of accounting for its 30% investment in Rex common stock. During 2008, Rex paid dividends of $300,000 and reported earnings of $900,000. In addition, the dividends from Rex are eligible for the 80% dividend received deduction. If one corporation pays another corporation dividends, all right, then dividends received from another corporation, all right, who own 20% or more, all right, are eligible for the 80% dividend received deduction. Now, all of the undistributed earnings of Rex will be distributed in future years. Now, there are no other temporary differences. Bart's 2008 income tax rate is 30%. The enacted income tax rate after 2008 is 25%. And Bart's December 31st, 2008 balance sheet, what is the deferred income tax liability? All right, now, let's make the entries that we would make on the books to show the entries under the equity method. All right, now, first of all right, in the question, Bart, all right, owns a 30% investment in Rex. So Bart has to pick up 30% of Rex's earnings, all right? 30% of $900,000 is $270,000. So under the equity method, we'll debit investment for $270,000, and we'll credit an account called equity in earnings for $270,000. Now, what we're showing here is this, all right? If the company you invested in, all right, their equity goes up, all right, due to the income, then your investment goes up because the investment represents the investor's interest in the investee's equity, all right? Now, because the investment went up, you're picking up your share of the investee's earnings, all right? So this is like a dividend account, all right? But, all right, we don't call it dividend income under the equity method. We call it equity in earnings. And this only appears on the financial statements. It does not go on the tax return. Now, the next thing, all right, it says here, Rex paid dividends of $300,000. Now, Bart's share is 30%. Under the equity method, when you actually receive dividends, all right, it's going to reduce your investment account, and also, all right, you're going to have to debit cash. All right, so what we're going to do is we're going to take 30% of the dividends, which is 90. 30% of $300,000 is 90. All right, so we'll debit cash for $90,000 and credit investment for $90,000. So under the equity method, when you pick up your share of the investee's dividends, that's considered a return of investment. But this $90,000, all right, is going to be reported on the tax return because you receive cash dividends. Now, the thing they wanted to say here is this. You have to pick up a deferred tax liability. Why? This is a timing difference. Now, in the question, it says, all of the undistributed earnings of Rex will be distributed in future years. Now, this is your share of the earnings. This is the amount that's been distributed in 2008. The remaining dividends to be distributed in the future will be $180,000. This is the total earnings that the investor is entitled to of the investee. This is how much has been distributed. The remaining amount to be distributed will be distributed in future years. All right, and that's $180,000. Now, this is not a future taxable amount. Why? Because this is future dividends. Now, when Bart, all right, gets this $180,000 in the future, all right, Bart will pick it up on his tax return as dividend income. Now, Bart will be entitled to the 80% dividend received deduction. All right, so if you take $180,000 and you multiply it by 0.8, all right, the dividend received deduction is $140,000, 80% of this, all right, leaving you with a taxable amount of $36,000. Now, this $36,000 is also a future taxable amount to Bart. All right. Now, Bart is going to get $180 of dividends in the future, but it's not all taxable in the future because Bart's going to take the 80% dividend received deduction. So the amount that will be taxable in the future is $36,000. So for the accounting for income taxes, this is a future taxable amount. Now, what's going to be the rate in the future, right, when they get, all right, this $180,000, of which $36,000 is taxable? All right, the rate will be, after 2008, it's going to be 25%. All right, so we'll multiply this by 25% and future taxable amounts times future rates. That is $9,000. All right, and what do we call future taxable amounts times future rates? Deferred tax liabilities. All right, so my deferred tax liability is $9,000, letter B. All right, now if you don't understand that, go over it again, okay? All right, let's do one more question here. All right, let's do question number 26. Now, in question 26, it reads, on its December 31st, 08 balance sheet, Shin had income taxes payable of $13,000 and a current deferred tax asset account of $20,000 before determining the need for a valuation account. Shin has reported a current deferred tax asset of $15,000 on December 31st, 07. No estimated tax payments were made during 08. At December 31st, 08, Shin determined that it was more likely than not that 10% of the deferred tax asset would not be realized. In his 2008 income statement, what is the total income tax expense? Now, total income tax expense is made up of income tax expense current and income tax expense deferred. All right, now, let's make the entries for this question, and then we'll add up all the income tax expense current and all the income tax expense deferred. Okay? All right, now, first thing, all right, it says here, Shin has, all right, at 12/31/08, all right, Shin has income taxes payable of $13,000. So what we'll do is we'll debit income tax expense current for $13,000, and we'll credit income taxes payable for $13,000. All right, there's the first amount. All right, now the next thing, they have a current deferred tax asset of $20,000. All right, before determining need for a valuation account. Shin had reported a current deferred tax asset of $15,000 at December 31st, 07. Now, when you set up a deferred tax asset and a deferred tax liability, what you have to do each year is actually adjust them because they're balance sheet accounts. All right. Now, for example, if you have to increase a deferred tax asset, the increase will be recorded by debiting deferred tax asset and credit income tax expense deferred. If you have to decrease a deferred tax asset, you'll credit deferred tax asset and debit income tax expense deferred. And you'll do the same thing for a deferred tax liability. If it's increased, you'll credit deferred tax liability, debit income tax expense deferred. And if you reduce it, you debit deferred tax liability and credit income tax expense deferred. Now, what happened here? At the end of 07, the deferred tax asset was 15. At the end of 08, it was 20. So it went up by 5,000. So what do? Debit deferred tax asset, 5,000. Credit income tax expense deferred for $5,000. All right. Now let's see what else we have here. All right. No estimated taxes were paid, but Shin has to set up an allowance account. All right. And they say here at December 31st, 08, 10% of the deferred tax asset will not be realized. All right. Now, what's the balance of the deferred tax asset at the end of 08? 20,000. 10% of that is 2,000. All right. So what I have to do is this. I have to set up an allowance account for 2,000. All right. So what I'm going to do is I'm going to credit instead of valuation allowance, I'm just going to credit allowance for 2,000. And my plug is debit income tax expense deferred. That's a deferred for 2,000. That's a debit to income tax expense deferred. Why are you debiting deferred income tax expense? Because this allowance account has to do with future taxes. All right? You're saying I'm not going to collect 10% of the deferred tax asset. What are they saying? I'm not going to collect 10% of the deferred tax asset in the future. So this income tax expense has to be future, so it's income tax expense deferred. All right, now, let's get the balance for income tax expense total. All right, we have a increase for income tax expense current of $13,000. All right, we have here a credit for income tax expense deferred, $5,000. That will reduce it. And we have an increase to income tax expense deferred, $2,000. All right, so what is our total income tax expense? All right, it is 13 minus 8. It is 13,000 minus 5 is 8, plus 2 is 10,000. So you're going to show a total income tax expense, which is deferred and current, of 10,000. My answer there is, all right, what question was I doing? All right, question number 26. The answer is C as in Charles. And 27 says, under the current GAAP principles, which approach is used to determine income tax expense? Remember, it's an asset and liability approach. All right, so the answer there, 27, is A. All right, so let me give you the questions I want you to do, and then we'll do a simulation, a quick simulation. All right, now, please do multiple choice number 6, 7, 8, 9, 11, 14, 15. All right, do 24, 26, 27, 28. All right, please do 29, 30, 32, 33, 35. All right, do 36. And that is it. All right, just do those. All right, read the handout. Any questions? Call me on the instructor hotline. Now, I have down here to do the first simulation on page 497, and let's do it together. All right? It says here on page 497, here is the directions. In these following simulation, you were asked to complete several tasks relating to deferred taxes. The tasks are identified by the tabs shown above. Here's the situation. All right? They give you a income tax worksheet for the 3 years ended April 30th, 08, and they give you the pre-tax financial income. All right, that's the book income. All right, what permanent differences they have each year, what temporary differences they have each year, and the taxable income for each year. Now, they also give you the cumulative temporary differences, which are the future taxable amounts. So they give you each year's taxable amounts, all right? I'm sorry, they give you each year's future taxable amounts, all right? Now, they also give you the tax rates, all right, for each year, and, all right, they give you a deferred tax liability, all right, for each year, and deferred tax expense, that's income tax expense deferred, and the income tax expense current. Now, please note, if they don't say anything in the question about you knowing future tax rates, when you come up with these deferred tax assets and deferred tax liabilities, all right, multiply the future taxable amounts or the future deductible amount by the rate that's in effect for that year. Use the current rates unless they tell you they know the future rates. Now it says here, under the information, the tax rate changes were enacted at the beginning of each year and were not known to Lane at the end of the prior year. So what is it saying here? Lane did not know the what? Future tax rates. All right. Now, items 1 through 4 represent amounts omitted from the worksheet. All right. For each item, determine the amount omitted from the worksheet. Select the amount from the following list. An answer may be used once, more than once, or not at all. All right. Now, number 1, what is the current income tax expense for April 30th, 2006? All right. Now, what you do is you take your taxable income of $600,000 and you multiply it by the current rate of 20%. 600,000 times 20% gives you a current tax expense of $120,000. So you pick letter G as in George. All right. Now, the next thing says, what's my cumulative temporary differences at April 30th, 07? Right? So what you do is take the temporary difference each year and add it to the prior year, right? And that gives you the what? Cumulative temporary differences. All right? So what's the temporary differences for April 30th, 06? All right? It is 200,000. What's the temporary difference for April 30th, 07? 100,000. So therefore, at April 30th, 07, the cumulative temporary differences are 300,000. All right, now, number 3. What's the deferred tax expense for the year ended April 30th, 07? Well, we know this. Each year, we have to adjust our deferred tax liability, up or down. Same thing with deferred tax assets. Well, it just so happens that in this problem, all right, we have deferred tax liabilities, and they give you the amounts at the end of 06 and 07. Now, they want us to come up with deferred tax expense for the year April 30th, 07. All right. Now, let's adjust the balances. At the end of 06, the deferred tax liability was 40. At the end of 07, it was 75,000. So our deferred tax liability in April 30th of 07, you have to make an adjusting entry. And what's the adjusting entry? All right. You will credit at April 30th, 07, you will credit deferred tax liability for $35,000. The difference between the 40 and the 75. And your plug is to income tax expense deferred for $35,000. So therefore, our income tax expense, all right, at April 30th, 07 is $35,000, letter B. Letter B. All right, number 4. What is our deferred tax liability balance at April 30th, 08? Now, the way you do that is this, all right? Future taxable amount times future tax rate gives us our deferred tax liability. So therefore, if we want to get our balance at a specific date for the deferred tax liability, all right, we take our total cumulative future taxable amounts, all right, and multiply it by the rate in effect for that year. Now, in this case, we want the deferred tax liability balance at April 30th, 08. So what we do is, we see we have a cumulative temporary differences, which are future taxable amounts. The cumulative future taxable amounts are $450,000. We multiply that by the tax rate in effect for that year. All right? And now will give us the balance that will be in the deferred tax liability account at April 30th of 08. 450 times 30 is $135,000. It is letter H. Letter H. All right? Now, let's look at, all right, the next part of this question, 1 through 7. Describe circumstances resulting in differences between financial statement income and taxable income. For each item numbered, determine whether the difference is a temporary difference that results in a deferred tax asset, a temporary difference resulting in deferred tax liability, or a permanent difference. All right, now, number 1. For plant assets, the depreciation expense deducted for tax purposes is in excess of depreciation on the books. So therefore, the first year, taxable income is going to be lower than book income. And in the future, taxable income will be higher than book income. Now, when taxable income is higher than book income in the future, that's called a future taxable amount. All right? Future taxable amounts times future tax rates give us a deferred tax liability. You would zero in on B as in boy. Now, number 2, a landlord collects some rents in advance. Rents received are taxable in the period in which they are received. All right, so what happened? All right, if we record all the rents, all right, paid in advance, all right, to us in the current year, it's all going to be taxable in the current year on the tax return, all right, but only will be income for the amount that's been earned, all right, on the books. So let's assume we have this scenario. In 2008, all the rents received are $18,000, all right? But on our books, at the end of 08, only $9,000 has been earned, all right? Now what's going to happen in 09? In 09, we won't have any more income from those rents because they were all paid in advance when received, but we'll have $9,000 on the books. But, all right, what will happen in 09, the future year? Taxable income will be lower than book income by $9,000. This is a future deductible amount times the future rate will give us a deferred tax asset. So what you'll do is, all right, you'll color in, all right, deferred tax asset for number 2. Number 3, interest is received on a municipal bond. All right, that is never taxable, so that's a permanent difference. All right, cost of guarantees and warranties are estimated and accrued for financial reporting purposes. Now, what do we know about warranty expense? We accrue them in the year of the sale, but we don't deduct them until they're paid on the tax return. So warranties are always future deductible amounts. Future deductible amounts times future tax rates give us deferred tax assets. You'll color in letter A. Now, life insurance proceeds are collected on the death of a key officer. Life insurance proceeds are non-taxable, but they are book income. All right? They will never be taxable. So what we have there is a permanent difference. Now, bad debts are estimated and expensed in the income statement. No bad debts were charged to the allowance and written off during the year. Now, what do we know? On our books, all right, we accrue bad debt expense. But we don't write off the bad debts on the tax return until they're actually uncollectible. All right? So therefore, let's assume our bad debts on our, on our books, we accrue at $10,000. All right? But no deduction in 08 on our tax return. Now, what happens here? In the current year, taxable income is going to be higher than book income by $10,000. Taxable income is going to be higher than book income by $10,000. But in the future, this will reverse itself. All right? This $10,000 deduction will be on the tax return, but nothing on the books. So in the future, all right, if this $10,000 deduction is on the tax return, but not on the books, this is a future deductible amount times the future rate will give us a deferred tax asset. So what you're going to do is color in, all right, deferred tax asset for number 6. All right, goodwill is deducted on the tax return. All right, you can deduct goodwill on a tax return, but goodwill is no longer written off on your books because it has an indeterminable life. So therefore, goodwill is now a permanent difference. All right, now let's look at the deferred tax calculations. Indicate whether each item would create a deferred tax asset or deferred tax liability, and whether each item would be classified as current or non-current. All right, now, tax depreciation in excess of book depreciation. Well, that's going to end up giving us a what? All right, taxable income is lower this year, but in the future taxable income will be higher. So that's going to give us a deferred tax liability, and we can relate it to a fixed asset, so we're going to show it on the balance sheet as non-current. Now, bad debt expense. All right. Now, bad debt expense in excess of actual write-offs. All right. Now, we showed you there that it's a deferred tax asset. Now, bad debt expense is related to accounts receivable, which is a current asset. So this will be a deferred tax asset. All right. And it is current. It is current. Rents collected in advance. Rents collected in advance for the next 12 months. All right, now, what happened? All right, we collected all the rents on the tax return in 2008. So it's all taxable when received. Only $18,000 was earned on the books. Now, what's going to happen? During the next 12 months, all right, nothing more on the tax return, because we earned it all on the tax return in 2008, but $18,000 on the books. All right, now, I'm sorry, on the tax return it'll be 0, not $36,000. All right, so what's going to happen here? Taxable income is higher by $18,000, but in the future taxable income will be lower than book income. All right, now, what happens when taxable income is lower than book income? All right, that gives you a future deductible amount. All right, future deductible amount. All right, which gives you a deferred tax asset. So we have a deferred tax asset. All right, now, we can't relate this rent collected in advance to any specific asset or any specific liability. But what happened here? All right, this timing difference reversed itself during the next 12 months. So therefore, we're going to show it on the balance sheet as a what? Current deferred tax asset. All right? Now, what I want you to do is this. All right? I want you to do, all right, I want you to read the research part. Now, once again, you can practice the research, all right? Because all you have to do is, once you get your notice to schedule, all right, you go to this. All right? You need your notice to schedule number. www.cpa/exam.org. All right? That will take you to the AICPA's research literature. And what you can do is, for this research, all right, you can actually do this. Read it. If they want you to go to the research to prove what you have to state, then you can practice with the actual literature. All right? And you have the solution to this question in the back. So you can see, all right, if you are close to what their answer is. All right? Now, also, all right, on page 4, all right, 499, I want you to do simulation problem number 2. And, all right, I want you to do the first part. You read the situation, then do the temporary and permanent differences, all right? And they say here, prepare the schedule for deferred tax amounts for the year. All right? Choose the items from the following list. Now, if you have any trouble with that, first look at the answer in the back. If you can't figure it out then, call me and I'll go over that with you. All right? And then on page 500, they want you to complete the following table to calculate taxable income. If no adjustment is needed for a particular item, enter 0 as your calculation. And then, all right, the next thing is prepare the journal entries to record the tax expense for 08. Select your account titles from the following list. When you make the journal entries, use these account titles. All right? And, all right, the next thing deals with disclosures. It says, using the appropriate netting procedures, indicate the amounts that will be shown in which of the following classifications. All right? So, you have to tell them how much of the deferred tax asset is current, how much of the deferred tax asset is non-current, how much of the deferred tax liability is current, how much is non-current, and then they have, all right, it says here, this is a written communication, okay? All right? Now, all I would do here is this, all right? Read what the written communication is asking for, and just read the solution in the back to give you an idea of how to write a written communication. Because remember, of the written communications, there are 2 of them on the exam, 1 in each simulation. However, 1 of them is a pre-test question. All right? Now, look at page 501, how, all right, it looks to write a written communication. And then, all right, on 501 on the bottom, assuming you have access to the research, all right, it says use the authoritative literature from the FASB original pronouncement, select the appropriate paragraph that provides the definition of deferred tax expense. All right, now, what you do here is, all right, you will type in the keywords, or do you press the tab? Which one is it first? Do you know, John? All right. What?
Keyword.
You write in the keyword, and then after you write in the keyword, what happens, John?
The screen comes up and you push the selector button.
All right, the screen will come up, and then you'll press the select button. What does the select button do, John?
The bubble.
The bubble, all right? And what does the bubble do?
Transfer it to your answer.
All right, it'll transfer the information to the computer screen to get your answer. All right? Now, once again, go to this website, all right, and practice and make sure you know the computer screen. All right? If you practice with their computer screen, all right, once you do it once, all right, you won't have any problem with the research, okay? All right, so that's basically it for deferred taxes. All right, usually they give you multiple choice, all right, but they can give you a simulation, all right, such as explain to them how you determine the classification of a deferred tax asset, deferred tax liability as current, all right, non-current. They could ask you that. All right, they could ask you what a deferred tax asset is, what a deferred tax liability. All right, I've gone over this with you. Review the material, and you should know this. And once again, all right, you can look at my handout. All right, but if you go over the multiple choice, the larger problems, you're going to be an expert on deferred taxes. Okay?